What happens when a flashy CEO tries to steal his own company, and Wall Street's most ruthless dealmakers fight back? This is the story of the $31 billion battle for RJR Nabisco, featuring corporate jets, golden parachutes, and the birth of modern private equity. Let's start in 1985. Two major American companies decide to join forces. On one side, R.J. Reynolds Industries, the tobacco powerhouse behind Winston, Camel, and Salem cigarettes, brands that generated massive, predictable cash flows but faced growing health concerns and declining smoking rates. On the other side, Nabisco, the beloved food giant responsible for America's favorite snacks: Oreo cookies, Ritz crackers, Wheat Thins, Lifesavers, Planters nuts, and A1 steak sauce. Nabisco had strong brands but lower profit margins than tobacco. The logic was brilliant. Combine tobacco's cash-generating power with food's growth potential and beloved brands. The result? RJR Nabisco, instantly becoming one of the world's largest consumer products companies, with steady profits from cigarettes funding expansion in the food business. Frederick Ross Johnson wasn't your typical corporate executive. Born in Winnipeg, Canada in 1931 to a lower middle-class family, Johnson used military scholarships to attend the University of Manitoba, earning a commerce degree in 1952. He then got his MBA from University of Toronto in 1956. Johnson's career was a masterclass in corporate ladder climbing. He started as an accountant at General Electric, moved to vice president at the T. Eaton Company, then became president of Standard Brands. But Johnson had bigger ambitions. In 1981, he orchestrated Standard Brands' merger with Nabisco, then worked his way up to CEO. A few years later, as Nabisco's chief, he arranged another merger, this time with R.J. Reynolds, creating RJR Nabisco. Johnson was known for his lavish corporate lifestyle, a fleet of corporate jets, expensive perks, and bold decision-making. He believed in living well while building businesses, and his compensation packages reflected this philosophy. Enter Peter Cohen, a bold, cigar-smoking leader who changed Shearson's future. After American Express bought Shearson in 1981 for $900 million, Cohen went on a buying spree. He picked up Lehman Brothers in 1984 and E.F. Hutton in 1987 after the market crash. By 1988, Shearson Lehman Hutton had 47,000 employees and had become a major Wall Street force known for its speed, ambition, and high pressure. Henry Kravis, born in 1944 in Tulsa, Oklahoma, came from a well-connected family. His father was an oil engineer and former partner of Joseph P. Kennedy. After earning his MBA from Columbia in 1969, Kravis joined Bear Stearns, working under Jerome Kohlberg with his cousin George Roberts. The trio pioneered bootstrap acquisitions, buying undervalued companies mainly with borrowed money. When Bear Stearns refused to back their ideas, they left in 1976 to form KKR with just $120,000. By 1988, KKR had become the leading force in leveraged buyouts, completing billion-dollar deals and delivering 36% average annual returns for investors. After the 1987 stock market crash, RJR Nabisco's stock price tumbled from the mid-60s to the low 40s and stayed there. Despite the company's strong earnings from both tobacco and food divisions, the market seemed to ignore RJR Nabisco's true value. Johnson was frustrated. He believed the company was worth much more than its stock price suggested. Investment bank Smith Barney estimated the company's breakup value at $85 to $92 per share, nearly double the trading price. Johnson felt the public markets didn't understand or properly value the company's assets. In October 1988, Johnson made his move. He announced the management buyout proposal, partnering with Peter Cohen's Shearson Lehman Hutton. The plan? Take RJR Nabisco private for $17 billion, $75 per share. But here was the controversial part. Johnson and 7 other managers would receive a 20% equity stake without investing any of their own money. Plus, Johnson negotiated a $100 million golden parachute for himself. The board was shocked and offended. They felt Johnson was using inside knowledge to grab the company on the cheap while enriching himself. Instead of accepting his proposal, they put RJR Nabisco in play, opening the bidding to everyone.
Henry Kravis had actually suggested the LBO idea to Johnson months earlier, but when Johnson chose to work with Shearson instead, Kravis felt betrayed. On October 24, 1988, KKR struck back with a hostile tender offer, $90 per share, $20.3 billion. KKR's bid was backed by institutional investors including pension funds from Coca-Cola, Georgia Pacific, and university endowments from MIT and Harvard. Unlike Johnson's management bid, KKR could proceed without management approval. A true hostile takeover. What followed was nothing short of the most intense bidding war in Wall Street history. Round 1. Johnson and Shearson opened strong at $92 a share, but KKR wasn't backing down. They immediately fired back with $94. Then came round 2. Johnson and Shearson pushed the offer up to around $100, maybe even $101 per share. And again, KKR countered, this time $106 per share. But the real drama unfolded in the final round. Johnson and Shearson went all in with a massive $112 per share bid. That's roughly $25.2 billion. KKR's final offer? $109 per share. In cash terms, that was about $24.88 billion, or $31.1 billion if you count the debt. It was a fierce, high-stakes showdown, and by the end, Wall Street had just witnessed a bidding battle for the ages.
So, on November 30th, 1988, the board shocked everyone. They went with KKR's lower bid. Why? There were 4 big reasons. First, KKR's deal structure was just smarter. Their offer had what's called reset provisions, basically built-in safety nets. If the market shifted, the terms would adjust automatically, protecting both bondholders and shareholders. It made the deal look way more stable. Second, KKR had rock-solid financing. Their money was guaranteed by major financial institutions. On the other hand, Shearson's financing came with a bunch of conditions, meaning there was a real risk it might not even go through. Third, there was a management trust issue. Remember Johnson's infamous $100 million golden parachute? Yeah, that blew up in the media. Time magazine's cover literally called it a game of greed. The board started doubting whether management cared about the company or just their own paychecks. And fourth, KKR offered better terms all around. Shareholders got to keep 25% equity compared to 15% under management's plan. And they even promised stronger protection for employees. So, in the end, even though KKR's bid was technically lower, the board saw it as safer, fairer, and more trustworthy.
After KKR's victory, RJR Nabisco became the most famous leveraged buyout in history, and one of the most painful. The $31 billion deal left the company drowning in debt, forcing years of asset sales and restructuring. What was once a powerhouse built on Oreos and Camel cigarettes slowly crumbled under the weight of its own financing. In the end, the RJR Nabisco saga wasn't just about numbers, it was about ambition, ego, and the limits of financial engineering. Johnson lost his company, KKR lost billions in value, and Wall Street learned a lesson it would never forget. Even the smartest deal can fail if it ignores business fundamentals. The battle for RJR Nabisco marked both the peak and the end of the 1980s LBO era, a symbol of how greed, power, and innovation collided to reshape corporate America.